Establishing your investment objectives. Ask yourself, what are your financial aspirations? Are you setting aside funds for a home purchase, short-term, 1 to 3 years? Your child's education or wedding, medium-term, 5 to 10 years? Or planning for your retirement, long-term, 10 plus years? Why it matters? Your objectives will determine the type of fund and the degree of risk you ought to evaluate. Comprehending your risk appetite. Ask yourself, how at ease are you with the fluctuations in the value of your investment? Do market variations easily concern you, or are you able to endure the highs and lows? Why it matters? Aligning your risk tolerance with the appropriate type of fund is essential to minimize stress and mitigate potential losses. Example, if you are a conservative investor focused on preserving capital, low-risk debt funds may serve as a suitable starting point. Conversely, if you are comfortable with market volatility in pursuit of potentially higher returns, equity funds might be a better fit. Analyzing categories of mutual funds. Equity funds. These funds primarily allocate resources to stocks and are most appropriate for long-term objectives, 5+ years, with a higher risk appetite. Their goal is to achieve long-term growth. Equity funds can be further divided based on market capitalization into large cap, mid cap, and small cap funds. Large cap funds focus on investing in well-established companies and typically exhibit less volatility compared to mid-cap or small-cap funds. Debt funds. These funds are dedicated to investing in fixed-income securities such as bonds and are well-suited for short to medium-term objectives, 1 to 5 years, with a lower risk appetite. Their primary aim is to provide stability and generate income. Liquid funds are included in this category and are ideal for very short-term requirements, 1 day to 3 months, or as emergency funds. Hybrid funds. These funds integrate both equity and debt investments, striving to achieve a balance between growth and stability, making them appropriate for individuals with moderate risk tolerance and medium to long-term objectives. Assessing fund expenses. Expense ratio. This refers to the yearly fee imposed by the mutual fund company for the management of your investments. Tip: seek out funds that have lower expense ratios, particularly in passive investment options such as index funds, as these charges can diminish your total returns. Generally, expense ratios are higher for actively managed funds and lower for those that are passively managed. Exit load. Certain funds may impose a fee if you decide to sell your units prior to a designated period. Tip: if you foresee the need to access your funds sooner, choose funds that have no exit load or a minimal one. Evaluating historical performance and consistency. Look at the track record. Examine the fund's historical returns across various timeframes, e. 3, 5, and 10 years. Compare to benchmarks and peers. Assess whether the fund has consistently surpassed its benchmark index, e. Nifty 50, and other comparable funds within the same category. Why it matters? A fund that demonstrates consistent performance over an extended period is generally considered more dependable than one that shows significant short-term gains but lacks consistent results. It is important to note that past performance does not guarantee future returns. Comprehending the investment strategy and fund manager. Investment strategy. Select a fund whose investment strategy resonates with you and aligns with your objectives. Fund manager expertise. In the case of actively managed funds, investigate the fund manager's background and performance history. A reliable and seasoned team can enhance consistent results. Expanding your investment portfolio, optional, for somewhat more assured beginners. Distribute your investments. After selecting your initial funds, think about diversifying among various asset classes or fund categories, a combination of equity and debt, to mitigate risk. Illustration: for long-term objectives, you may want to allocate a segment to equity funds, a portion to debt funds, and a minor percentage to alternative assets such as gold. Commencing with SIPs and maintaining discipline. Systematic investment plans, SIPs. This entails investing a predetermined sum at consistent intervals, such as monthly or quarterly. Advantages: SIPs assist in avoiding the temptation to time the market, averaging the cost of your investments over time, and fostering a disciplined investment routine. Remaining invested, patience is crucial. It is important to resist the impulse to sell in a panic during temporary market fluctuations. A long-term commitment is vital, especially for equity investments. Evaluation and adjustment. Periodic evaluation, annually, assess your portfolio to confirm it remains in alignment with your objectives and risk appetite. Adjustment: should your portfolio deviate due to market fluctuations, modify your investments to realign with your initial asset allocation strategy. Evaluating underperformance: if an actively managed fund persistently falls short of its benchmark for 2 or more years, contemplate substituting it with a more favorable alternative. Pursuing expert counsel, strongly advised for novices. Consult with a financial advisor. If you are uncertain or require tailored advice, engaging with a certified financial advisor can prove to be extremely beneficial. They can evaluate your unique circumstances and suggest funds that are customized to meet your particular requirements. By adhering to these guidelines, newcomers can develop a comprehensive understanding of how to select mutual funds that correspond with their financial objectives and risk tolerance, thereby positioning themselves for successful long-term investment.